So our portfolio tends to have a beta of about 1.15. We are valuation disciplined. We're happy to pay a premium, but we want to be careful how much. And I think that's worked really well in the sense that we've managed to navigate, I think, through those different types of period.
Hello from Frankfurt am Main. We are here today talking about tech investments, and with me is Ian Mortimer from Guinness Global Investors. Hello, nice to have you.
Great, lovely to be here.
We have a lot of talking points at the moment in the market. Of course, geopolitically, a lot of things are happening, but focusing on the tech sector, would you say the software sell-off was the biggest talking point we had already this year?
Yeah, as you say, obviously, geopolitical tensions and the war in Iran has sort of overtaken what's happening in markets over the last few weeks. But yeah, you're dead right. The big thing, from a growth investor perspective, has clearly this year been the impact to the software sector from agentic AI, the Anthropic release particularly, and some of the co-work systems that we've seen, and how that's really moved across lots of different sectors as well. So it's not just the software sector. We saw it move into lots of other areas, and clearly some of those moves have been very dramatic, and that's very different to what we've been seeing in terms of markets over the last few years, where software has generally been really valued very highly by the market in terms of the asset-light business model and so forth. And so that's definitely been something which it's been really challenging and super important to think about.
And the talking point about the capex spending of the big AI companies, and generally the talking about the AI bubble or bursting of a bubble, would you say those are still discussion topics at the moment? Because it seems like they're a bit in the background now.
Yeah, no, I think absolutely. I mean, I think, when we're thinking about our portfolio, it's sort of two things really. So you've got, when we're thinking about tech, we're a growth investor, so about 45% of our portfolio is in IT. But within that, you've also got the different industries. So you've got semiconductors, hardware, and then you've got the software. And actually, semiconductors have done incredibly well. So when you're thinking about that tech space and what's been happening, different areas of that market have been very different. So it depends what your exposure has been in terms of the impact. When we think about the AI capex spend, that's also been a big driver to some of those sectors. So if you think why semiconductors done well, is because the AI capex spend and the data center build out's been so important. Whereas the market, rewarded those companies was last year as they increased capex. It was really seen as a proxy for demand. You increase capex, I've got more demand, the market rewards it. But now the numbers are getting so big, I think the market is beginning to question, what does that look like? And what does that mean, particularly in terms of their long-term return on capital? And is that business model changing? In the short term, it's difficult to know. We've seen some data points through Alphabet, for example, about how they think you should model the company. It's not cost per click anymore, for example. So how do we think about that? But also, if you're thinking about something like Oracle, it looks really different. So if you're just looking at things like free cash flow to capex, then for Oracle, the other way around, capex to free cash flow is above 100%. So that's why the market's not rewarding that particular company and thinking about debt, was maybe the others were actually below that, although it's creeping up towards that level. And I think that's the tipping point where the market's saying we really need to understand what this looks like, even though we believe the demand is there. And obviously that's something we're looking at pretty closely too.
And there are a lot of different growth strategies and growth funds. How would you say are you positioning through this kind of very wide spectrum?
Yeah, you're right. I think over the last sort of 5 or 6 years, there's definitely been a better understanding from clients of the different types of growth approach, and they're all valid for different reasons. But one way we've seen is the sort of higher growth type approach, where you're really sort of saying, well, actually, if you can find those best, fastest growing companies, then actually maybe valuation isn't so important in the sense of they're going to dominate. The issue we would see with that is, as we've seen sort of post-pandemic or an interest rate regime change, is that can be impacted. Valuations, we believe, are important in the context of growth. I think at the other end of the spectrum, you've got more of the sort of quality growth type approach, where maybe portfolios have slightly more ballast, you might argue. Things like consumer staples, more modest growth, might dampen the beta, for example. But they've maybe struggled more recently because they haven't captured the upside as much, particularly from that AI trade. We would argue we sit somewhere between the two. So our portfolio tends to have a beta of about 1.15. We are valuation disciplined. We're happy to pay a premium, but we want to be careful how much. And I think that's worked really well in the sense that we've managed to navigate, I think, through those different types of period somewhat better, we believe. And we think that's still a good place to be. Be worried about valuation, look for that growth. Maybe we don't want to stretch too far in terms of that higher valuation for the extreme growth, because we know that's pretty difficult to get right on a regular basis.
And digging a bit deeper into your portfolio at the moment, where do you see alpha sources for your strategy? Where are you positioned to generate this alpha?
Yes, I think we've still got quite a big overweight to the semiconductor space, and that's through lots of different areas. So it's through the fabless type businesses, it's through other companies like the fabrication equipment makers, the semi-cap equipment as well. We still think that's a super interesting place, although we do recognise valuations have moved beyond that. And then also just thinking outside of tech. We've got good exposure to areas such as healthcare, for example, some of the financials. And I think it's also important to sort of, when we think about growth, that tech has dominated and it's been a really good place to be. But there are other areas of the market that can provide that above average market growth that potentially today might be offering better value. And we're trying to kind of put that together across our portfolio and diversify some of those risks where we can.
An overweight in semiconductors, but also finding alpha and growth in, let's say, more traditional sectors, says Ian Mortimer from Guinness Global Investors. Thank you very much.
Thanks for having me.